Okay, let's get into trade selection. Trade selection is really part art, part science as always. We want to, of course, always trade with confidence. So what we're going to do is we're going to take a look at some of the index options that we can put positions on and begin building our portfolio. And that's what we really want to focus on is the idea of building a portfolio. It's not just putting on, a position here, a position here that doesn't really make any sense. What we want to try to do is create a portfolio of positions that really helps us achieve our objective of generating monthly income from the market. So in our test account here, what we want to do is we want to try and obviously first want to look at the indexes that we want to put positions on. And normally what I do is I take the EEM, which is the iShares Emerging Markets. Let's take a quick look at a quick graph of it. This is the iShares Emerging Market ETF. It seems to be trading very well for us. It tends to trend in a pretty nice pattern. It tends to stay within channels here. Like I said, I'm not a big technical analysis guy, but what I like to do is I like to see support and resistance points, and I like to check channels over time. So I mean, like, this has been in a channel now since back in early October. It's just kind of stayed in this little channel, kind of a downtrend channel here. I've got a potential, these blue lines are a potential uptrend channel that it might be following, but it did hit this resistance right in here at this upper, the old channel line that I've got at the upper resistance. So we may continue to see it trend lower. On the other hand, I've got this blue uptrend channel, and just in case it changes directions. But as you can see right now, it hit a high of around 144. It started to drift down here over the last 4 or 5 days. Now, how would we play this? You can see that it's been in a downtrend. It's been following this channel pretty closely. When it's dipped below, it's come back up and it's hit the upper trend line now. 1, 2, 3, at 4 points. So there's a solid downtrend in effect. It's also below its 200-day moving average. So, it got above it, now it dropped below it. So that even is a stronger indication that it may continue lower. So how do we play this then? How do we play this? Well, in most cases, what you're going to be doing is I like to put on double calendars as my opening position. A double calendar with a calls just above the current price and puts below the current price. At this stage, because it's in the upper quarter of this channel, you might want to give it a little bit more room to the downside. So let's say if it does start to follow this blue line, it starts to follow this upward channel here. I want to try to find puts right around the 132.50 level, which is the edge of the lower channel line that I've already set up here. We've got 1 point on it, so it's not really a confirmed channel line yet. But on the upside, you've got about 3 points where it's hit, and it looks like it's trying to follow it. So if it does, obviously we cannot predict the future. I've tried to emphasize that as much as possible throughout this course, is that you can't predict the future. All you can do is kind of follow what the trends are doing, and then as we go along, I think the most important thing that you can do is know how to adjust your trades after you get them in. We are at a position now where we need to put this on, because I like to put on positions. If you look at the May options, we're 32 days out of expiration. We like to put them on between 30 and 40 days. We've got our Junes out here at 67 days, so we'll probably do a May-June, but we have to look at the volatility levels. The volatility levels, if you come over here, are pretty close, although June seems to be just slightly higher. We can also take a look at the Septembers and see how they what the volatility levels of the Septembers are, but that's pretty far out. I mean, if I'm writing the May options, selling the front month, I don't like to go more than 3 months out. So if I go 3 months out, that's June, July, August. September is a bit of a stretch. So because once you go out a little bit further in the months, then volatility could be an issue. Could be an issue. So, but we're going to take a look at those when we go to trade selection. Right now, we're still looking at the chart. So what we want to do is see if we can't hit this. Do a double calendar, maybe around the 145 level here on the upside because it's showing some resistance here, and maybe 132 if they have that strike, or 130 on the downside. That may not set up a very good double calendar for us, but we can try it out. So let's go into our trade tab in the TOS platform. Go to May. Now I already have I have a current position on here that I'm doing for April, but we'll ignore those for now. There's only 4 days left on that. Let's see. We mentioned the 145 level on the upside. So let's take a look at these. We may even want to go to the 150s, which would be this upper trend line here if we can get a decent price for them. And the picture looks good. So let's take a look at this. We're going to buy. We're going to right click, go to buy calendar, and then we're going to go down to our lower strike, which was right around 132 or 130. If we can hit 130 at a decent price, let's do 130. Well, we might even be able to get the 125s, which would give us even more downward protection. So if we can hit 125, that might be okay too. But let's try the 130s and see what the graph looks like. We're going to go to right click, buy calendar. Oops, I got to set the advanced order to blast all. Actually, we're not putting these on individually. We're going to do a calendar as a double calendar as one order. That's the best way to do this. If you're adjusting, you may want to do it differently, but we're going to do this in we want to submit this as a single order, double calendar. So we're going to go to buy, double diagonal, and double calendar. So we're going to click on that, and this will bring up our strikes. Now we're going to have to change these. We want the 150 calls, which are fine, but we want the 130 puts. So we got to go down to the puts and put in the 130s. Okay, and now, so we double check this. We're buying one of the Junes. We're selling one of the Mays at 150. We're buying one of the June 130s, and we're selling one of the May 130s. Okay, and this is for a $4.68 debit. Let's go right click. Now you can right click on this little blue thing here, but I've found it's easier just to click anywhere in this green area. Just right click on that, and we're going to analyze this as a duplicate trade. Now I have to eliminate my current position, so we're going to hide positions down here, and we're going to take a look and see what this is going to look like as a double calendar. Okay. It looks like we're a little bit off center, and we've got a big sag in the center here. So it looks like we're going to have to tighten up our strikes a little bit. Let's go with a 145. The 145 calls. And we'll keep our 130 puts. That looks a little bit better, right in the center. We've got a couple $100 of profit. We got to change that. Now we're going to be paying $5 a debit. Whenever you have right down here, if you see this little red lock, that means you locked in. If you change any of the parameters, it's going to lock in the debit that you're paying. But if you change any of these parameters, if you change the strike prices of your calls and puts, then you need to unlock this to get the current price on this double diagonal. That looks a little better, doesn't it? Now, let's see. Let's set our slices so that we're break even. And we want them to break even on our Mays. And so we just... all we had to do was set our slices to break even on the May 17th. We want to set our probability date out to May, the expiration date. And I think we're good to go. Okay, this looks pretty good. I mean, you know, we've got our tent set up here. This is the graph that we want to see. This is exactly what we want to see. We want to have wide break-evens. We want to have the green line again is our expiration, is the profit at expiration or loss. So our peaks are about 257 and 297, a little bit higher on the upside. Right now we're pretty close to the center of this little tent. And I mean, the price is not too bad. I mean, obviously, if we can shave, see what I'm doing here now is I'm taking a look at this $5 debit, which is the midpoint. If we can shave this down a little bit, you can see that we get into profit pretty quickly. But you know what? Nobody gives you anything in the market. They just don't give it to you. I mean, if we can hit our mid price of $5, we'll be considered extremely lucky here. Where am I? Okay, analyze. Okay, what we want to do now is just kind of take a look at this. That looks pretty good. We've got 150 on the upside as our break even. We've got 125, 26 on the downside. Let's take a look at the graph again. We got 150 on the upside, which is good. That's right where, if it does break through and follow this blue uptrend line, we'll probably hit the top of it right around 150. And that's what we want to do. If we hit the bottom, let's see, where's our break even on the bottom? It's about 126. So we're right down in here, which is a pretty good level. I mean, it could go down lower than that if we continue in this downtrend channel. But we've got a pretty wide range here. Now the EEM can move. I mean, it can go up pretty strong one way or another. But we've got a pretty wide profit range here, which gives us a little bit more confidence. So what we want to do is, now that we have these in position, and we can play with this a little bit more, let's pull the puts up to the 135 level. What does that do to our break even? The break even now is just below 130. Well, if we think there's we got to get rid of this red lock here. We're going to pay a little bit more for the debit. And remember, your maximum loss on a double calendar is the debit that you paid. So $5.25 is our maximum loss on this. And if you look at the prices here, we can set our slices to a different parameter. You can see that the margin required for the calendar is $523, and that's also our maximum loss. So let's take a look at this. We're just to spread those out a little bit. Now, our break even to the downside, if you were slightly bullish, this would be a better play, because the break evens on the downside moved up to the 130 level, and the break evens on the upside now is up around 151 or a little bit higher. So if you were slightly bullish on this, you might want to just play with those numbers a little bit, and bring those puts up to a closer to the strike price, and move those calls out a little bit, which they are at 145. That gives us a higher break even on the upside. But since it may appear that we're still following that downtrend channel, we're going to keep our puts at the 130 level and our calls at the 145 level. And I think that'll work out very well for us here. And we're pretty much in the center, so we could go down, we could go up. It doesn't matter too much. We'll still be in a profitable position. Now, to order this, to put this position into the order queue, all you have to do is take a look at this, right click, hit confirm and send, and it'll bring up the order confirmation dialog box. And what we're doing is we are putting in a double diagonal. This is a calendar spread, and we just want to make sure that everything is correct here. 145s, 130s, 145, 130. So we're doing the calendar. We're doing a double calendar. The cost of our trade is $4.98. $6 in commissions for a total cost of $504. And that is also, if we take a look at this, $498 is our margin requirement, and it's also our maximum loss on this trade. Now this is what we're going to be doing for an initial opening trade. Remember, if we do have to do adjustments, that is fairly easy to do once we have this position on. But it's critical to understand adjustments, because if the price gets very quickly to our upper side of our break-even points, up to the around 150, 151 level, then we need to do some adjustments here. Or if it goes down to our 125, 126 level, we need to do some adjustments there as well. But this is how we set up our initial position. We really want this center line here that you see, 138.48, is our live price. That's the current price. You can see it here. And if you click on underneath the delta sign, you see this little wrench. If you click on that, you can also see what the current price is, 138.48. And that's all we have to do, really. All we have to do is just right click on this. We are going to confirm and send it. And we are going to send that off to the market and see if they give us our price. If we go back to our trade tab, and we are going to try, they are working on it now. Let's take a look. Okay, the current price moved away from us. This is what happens sometimes. You know, we put it in at 498, and now the market has moved a little bit against us. It's at 499. So we're a penny off of the mid price, which means that we're probably not going to get filled on this. But you know, we'll see what happens. If we need to, we'll go back in a few minutes. Now it's moved again. It's moved up to $5. So, yeah, we may not get the prices that we want here, but that's how you kind of work these trades. We'll give it a few minutes. We'll give it about 5 minutes, and if they don't give it to us, then we'll go back into the market and change our price and see what we can do to get our order in. So that is how I do an initial evaluation. I'll take a look at the chart, take a look at our channels. Like I said, technical analysis is not a huge part of what we really do. We're not very good at predicting the future. However, there are trends and there are support and resistance points that you can take a look at to help you kind of figure out where you should be placing your double calendars. It's not rocket science. It's pretty easy to do. All you have to do is take a look at a quick chart, do a quick channel, and you know, that's about it. This seems to be moving away from us pretty quickly. It's up at 501 now, so we'll just kind of hang in there for a while. The prices are moving around quite a bit, and we'll just see what we can do. What we also want to do here is, and I should have done this first, is take a quick look at the volatility levels. The 130s are actually at 40.21. The implied volatility level on the May 150s are at 33.64, if we take a look at our Junes, they're at 39.74. So we're selling a little bit higher volatility here, and we're buying a lower volatility, which is what we want to do. We've got a positive skew, they call it. And at 150, we've got a 33.62, and we've got a 35.66. So we're fine. We should have taken a look at that, but usually with the index options, you don't get a lot of either a large positive skew or a large negative skew on these. They're pretty close to each other, so you don't have to worry about that too much. If we were doing an individual stock, then we would definitely want to take a look at those. And what I mean by a positive or negative skew is if the front month has a higher implied volatility than the next month or the month that you're buying, it has a positive skew. It's positive because you are selling a higher volatility, and if the volatility should come down, then you are in a better position to profit. A negative skew is if you have a lower volatility in the front month that you're selling and a higher volatility in the next month that you're buying. That is actually not a good position to be in, especially if it's 2 points or more, because what you're doing is you're selling a lower volatility. If volatility should decline, then your position will get hurt. It will not make as much profit, and you could possibly even see a loss on the position if volatility levels should decline significantly, or the volatility levels in the second month that you have your position on increase dramatically. So we're in a good position here. We're just going to wait and see if we get our order filled, and we should be fine. We're going to be putting in some other orders on our test account, and we'll be following those along as well in subsequent videos. But that's where we are right now. We will. I know the EEMs are extremely. They're pretty well traded. Let's just take a quick look at the volume on these. The volume. They're trading a couple hundred contracts. Here's the now obviously someone here is making a bet that the EEM is going to be dropping. Either that or they're protecting their ETF position. It could be insurance on their ETF position if they're buying the ETF itself, the underlying. We've got 2,100 contracts today already on the 135. Let's see what the open interest is. Open interests are quite high, so they're quite liquid. We've got 20,000, 18,000, 44,000, 43,000 on the call side. We've got 17, 18, 36,000 on the put side. So there's quite a bit of liquidity in these EEMs. I like the EEMs for index trading. The prices are quite good. They're a little bit more expensive to buy on a double calendar, but that also means that there's quite a bit more profit potential in these, and it seems to trend quite well. So that's it for today for opening positions. Refer to the TOS, using TOS CD for selection, order entry, help management for more information on exactly what we did here, because we went through quickly an analysis. We also went through the order entry system, and I want to make sure that you understand everything that we did here, and that's explained in the using the TOS platform. So, hey, trade with confidence, guys, and we'll see you on the next video.